You already know the war is happening. You've seen the headlines, you know about the strikes on Iran, the Strait of Hormuz, the gas prices going up. You've watched the news coverage. You're not here for a recap. You're here because you want to know what to actually do with your money right now. And that's the right question. Because while most people are frozen, watching the news, feeling anxious, doing nothing, there's a group of people who never freeze. Wealthy investors. People who have seen geopolitical crises before. People who have a playbook for exactly this kind of moment. Right now, as this war unfolds, they are making 5 very specific moves, not because they predicted this war, not because they have insider information, but because they understand how money moves during a crisis, and they've positioned themselves to benefit from patterns that repeat every single time a conflict like this happens. Gold, the dollar, defense stocks, energy, cash strategy. 5 moves, and none of them require a hedge fund. None of them require a financial advisor on speed dial. They require understanding, which is exactly what this video is going to give you. And by the end of this video, you'll know exactly what the rich are doing with their money right now, and whether any of it makes sense for you. Here's the problem with how most people think about war and money. Most people treat geopolitical news the way they treat weather. Something that happens to them, something they watch on TV, feel bad about, and then move on. They don't see a connection between missiles landing in Tehran and the $3.41 they paid for gas last Saturday. They don't connect Iran with their 401k. They don't see how a choke point in the Persian Gulf affects whether the Fed raises interest rates, which affects your mortgage, your car loan, your credit card balance. This disconnect is exactly what costs regular people money every single time a conflict like this happens. Now here's what actually happens. When the US and Israel launched Operation Epic Fury on February 28, 2026, something very predictable occurred. The Strait of Hormuz, a narrow strip of water between Iran and Oman, effectively shut down. Ships stopped moving. Insurance companies told tanker operators they would not cover vessels in the region. And just like that, 20% of the world's daily oil supply was stuck. Brent crude, the global benchmark for oil, jumped 13% in a single session. That's the biggest single-day move in 4 years. West Texas Intermediate, the U.S. benchmark, crossed $80 a barrel. Gasoline at the pump in the U.S. hit $3.41 a gallon on average, a jump of 43 cents in 1 week, according to the American Automobile Association. Morgan Stanley is now warning that if the strait stays disrupted, oil could surge well above $130 a barrel. Now think about what $130 oil does to your life. Gas goes to $4.50, maybe $5. Every product that gets shipped, groceries, electronics, clothing, gets more expensive because transportation costs rise. The Federal Reserve, which was about to cut interest rates, now has to think twice because inflation is coming back. And when the Fed holds rates higher for longer, your mortgage costs more, your car loan costs more, everything financed costs more. This is the chain reaction that most people never see coming. But here's the thing about wealthy investors. They don't just watch this chain reaction happen to them. They study these patterns. They've seen this movie before, in 1973 during the oil embargo, in 1990 during the Gulf War, in 2022 when Russia invaded Ukraine. Every single time there's a major geopolitical shock that touches energy markets, the same playbook gets run. And the people who know the playbook don't lose sleep. Here's the real separation between the average investor and the wealthy investor. It's not intelligence, it's not insider information, it's not connections on Wall Street. It's preparation. The clients that weather these crises best, and I'm pulling this directly from CNBC's Financial Advisor Council, are the ones who planned before the crisis started. But even if you didn't plan before February 28th, it's not too late, because the war is still unfolding, and the 5 moves we're about to break down, most of them are available to you right now, today, with whatever you have. Let's walk through each one. Move number 1, gold, the oldest safe haven in the world. Let's start with the most obvious one, but let's talk about it the right way, because most people either don't have it or don't understand why they should. On March 1, 2026, 2 days after the strikes on Iran began, spot gold surged past $5,246 an ounce. Before the war started, gold had already delivered roughly 22% gains year-to-date in 2026. The moment Operation Epic Fury launched, gold jumped another 2.3% in a single session. At one point, it briefly touched $5,400 an ounce, a record. Now, most people see that number and think, I missed it. And that's exactly the wrong way to think about gold. Gold is not a trade, it's insurance. It's the thing wealthy people hold precisely so that when moments like this happen, part of their portfolio is going up while everything else is chaotic. Here's the historical track record. During the 1973 oil crisis, gold surged over 2,000% over the following years. During the 2001 September 11 attacks, gold jumped 6% in a single day. During the Russia-Ukraine war in 2022, gold rose roughly 6% in the first month. The World Gold Council found that gold has averaged about 7.5% returns in the 6 months following major geopolitical events. And here's what makes gold particularly interesting right now. It had already gained 19% in 2026 before the Iran war even started. Meaning the smart money was already in gold, not because they predicted this specific war, but because they knew the world was getting more unstable, and they positioned accordingly. The good news for regular investors: you don't need to buy physical gold bars. You can buy GLD, the SPDR Gold Shares ETF, which tracks the price of gold and trades just like a stock. Financial advisors typically recommend 5 to 15% of a portfolio in gold as a baseline. In times of elevated geopolitical risk, some are now suggesting higher allocations. But here's where it gets really interesting. Move number 2. I-bonds. The government is literally paying you to fight inflation. Here's the thing about war and inflation. They always show up together. When oil prices jump 25% in a week, which is exactly what happened since the Iran strikes, everything else follows. Groceries, utilities, rent. The cost of living goes up and the purchasing power of your savings goes down. That's not a theory. That's what happened after every major energy shock in modern U.S. history. So the question isn't just, how do I grow my money during this war? The question is also, how do I make sure inflation doesn't quietly eat my savings while I'm not looking? And that's where I-bonds come in. Series I savings bonds are U.S. government-backed savings instruments specifically designed to protect your money from inflation. Not approximately, not partially. The interest rate is literally indexed to the consumer price index, meaning when inflation goes up, your return goes up with it automatically. Here are the numbers right now. The current composite rate on I-bonds set by the U.S. Treasury in November 2025 and active through April 2026 is 4.03% annualized. That rate is made up of 2 parts, a fixed rate of 0.90% that stays with your bond for up to 30 years, and a variable rate of 3.12% tied directly to inflation. When oil shocks push the CPI higher, which Goldman Sachs is now projecting is exactly what will happen, that variable component goes up at the next reset in May 2026. Most people have never heard of I-bonds, and the ones who have think of them as a boring, conservative investment for retirees. But here's what most people miss. In 2022, when inflation hit 9.1%, driven by the exact same type of energy shock we're seeing right now, I-bonds were paying 9.62%. While the stock market dropped 20% that year, people holding I-bonds were earning 9.62% guaranteed with zero risk of losing principal. Zero. The mechanics are simple. You buy I-bonds directly from treasurydirect.gov. No broker, no fees, no middleman. You can invest up to $10,000 per person per year electronically. Your principal can never go down. Interest is exempt from state and local taxes, and federal taxes can be deferred until you redeem. The only real constraint, you can't touch the money for the first 12 months. And if you redeem before 5 years, you give up the last 3 months of interest, which is a minor penalty for what is otherwise one of the safest inflation hedges the U.S. government offers. So think about what that means in the context of right now. If this war drags on, if oil stays above $100, if the Fed is forced to hold rates higher to contain inflation, your I-bond rate resets higher in May. The worse inflation gets, the more your I-bond pays you. That's not a coincidence. That's the entire point of the instrument. It's a savings tool designed for exactly this kind of environment. But here's where it gets really interesting. Move number 3, defense stocks. War is terrible. The business of war is relentless. I want to be very clear before we get into this one. Investing in defense companies doesn't mean you support war. It means you understand how the economy works. On March 2nd, the first day of trading after Operation Epic Fury, here's what happened to defense stocks. Northrop Grumman was up 6%. RTX, formerly Raytheon, was up 4.7%. L3 Harris was up 3.8%. Lockheed Martin was up 3.3%. The iShares U.S. Aerospace and Defense ETF jumped 4.8% in hours. But here's the bigger picture. Since January 2026, Lockheed Martin's stock has risen nearly 40% as U.S.-Iran tensions escalated. Northrop Grumman has gained 46% since the first U.S. strikes on Iranian nuclear facilities back in June 2025. RTX has risen 110% since March 2023. 110%. The reason is simple and uncomfortable. War consumes weapons, and weapons have to be replaced. The Pentagon confirmed that B-2 bombers, F-35 fighters, and Tomahawk cruise missiles were all used in the initial strikes. Raytheon makes the Tomahawk, Lockheed builds the F-35, Northrop operates the B-2. Every weapon system deployed maps directly to a company's stock price. And it's not just the immediate conflict. Morgan Stanley issued a formal advisory to investors recommending exposure to defense, security, aerospace, and industrial resilience because government spending in these areas creates multi-year demand pipelines. The fiscal 2026 defense budget is already $858.9 billion. The Trump administration is reportedly seeking an additional $50 billion on top of that. For individual investors, there are 2 practical ways to get exposure without picking individual stocks. The iShares U.S. Aerospace and Defense ETF, ticker ITA, which has already surged 14% in 2026, or Invesco's Aerospace and Defense ETF, ticker PPA. Both give you diversified exposure to the sector without the risk of betting on a single company. This is where most people mess up, by the way. They either panic and sell everything, or they watch defense stocks run 40% and think, I missed it. But if you look at every major conflict in U.S. history, defense stocks don't peak when the war starts. They peak when the war ends. And this war is 8 days old. Move number 4, energy stocks, the most direct play on the Strait of Hormuz. Here's a number to put in your head. 20%. That's how much of the world's daily oil supply passes through the Strait of Hormuz every single day. 20 million barrels. And right now, that strait is effectively closed. Tanker traffic has all but stopped. Insurance companies are refusing to cover ships in the region. 3 tankers were attacked over the weekend. Saudi Arabia has contingency plans to reroute oil through the east-west pipeline, but that's expensive and limited. Qatar, the world's 3rd largest LNG exporter, halted all gas production after Iranian drone attacks hit its facilities. Iraq and Kuwait have already begun shutting in production. The result, Brent crude hit $103 a barrel on March 9, 2026. Goldman Sachs says if Hormuz flows stay depressed, oil could surge well above $130. The U.S. Energy Information Administration, just weeks ago, was forecasting oil at $53 a barrel for 2026. We're now at $103. That is a doubling. For energy companies, this is a windfall. ExxonMobil briefly hit a record high of $159 a share, up nearly 30% in 2026. Wells Fargo raised its price target to $183. Every $10 increase in oil prices flows almost directly to Exxon's bottom line because their production costs in the Permian Basin are around $35 a barrel. When oil is at $100, that's $65 of pure margin per barrel produced. Chevron touched $196 a share, a new 52-week high. Their dividend and capital spending break-even is approximately $50 a barrel. At $100 oil, they're generating enormous free cash flow. For investors who don't want to pick individual stocks, the Energy Select Sector SPDR Fund, ticker XLE, holds Exxon at 22%, Chevron at 17%, and ConocoPhillips at 8%. It's trading near its 52-week high and gives you broad exposure to the energy sector in one trade. And here's what changes everything on this move. Even when this conflict eventually ends, the structural problems in oil markets don't. Underinvestment in new production over the past decade, rising costs in shale, a depleted strategic petroleum reserve. These are problems that existed before February 28th. The Iran war simply lit a fuse that was already laid. Move number 5, money market funds and short-term treasuries. The move nobody talks about. Here's what wealthy investors were doing in the days after the Iran strikes. They pulled $9.6 billion out of U.S. equity funds in a single week, the largest outflow in over 2 months. And where did that money go? Into money market funds, short-term treasury bills, high-yield savings accounts. Not because they gave up on investing, but because cash is a position. And when the outlook is uncertain, having liquidity gives you options. Here's the practical version for your life. Financial advisors consistently recommend keeping 6 to 12 months of living expenses in an accessible, liquid account. Right now, a high-yield savings account is paying around 4%. A 3-month Treasury bill, which you can buy directly at treasurydirect.gov, is paying 3.6%. These are not exciting returns, but they are safe, liquid, and they protect you from being forced to sell your stocks at a loss if you suddenly need cash. Most people don't do this. Most people are fully invested or fully not invested with no middle ground. But wealthy investors are always maintaining a cash buffer, always keeping dry powder. Because when markets crash, cash lets you buy. And crashes, whether from wars, recessions, or anything else, always end. The clients who come through crises the best are not the smartest people. They're not the ones who predicted the war. They're the ones who were already holding their emergency fund, already diversified, already had a plan. As TIAA's CEO put it directly, the clients that are best positioned to weather this uncertainty are those who planned for it before it happened. Now, here's where it gets real. Let's talk about what the next 5 years look like for 2 different people. Person A hears about the Iran war. They watch the news. They feel anxious. Maybe they log into their brokerage account and see their portfolio down. They don't do anything, not because they made a calculated decision to hold, but because they don't know what to do. The gas prices go up. The groceries get more expensive. Maybe they put a little more on the credit card this month. Life gets incrementally harder and they're not sure why. 5 years from now, person A is in roughly the same position they are today. Maybe slightly behind, actually, because inflation eroded the purchasing power of whatever savings they had sitting in a checking account, earning 0.01%. Most people are person A, not because they're not smart, but because they never learned this stuff. Now let's look at person B. Person B doesn't know exactly how the Iran war ends. Nobody does. But they understood the mechanics. They know that when geopolitical shocks hit energy markets, the same 5 categories respond. So in the weeks and months of this conflict, they had some exposure to gold, some exposure to energy, some allocation to defense, their emergency fund fully funded and sitting in a high-yield account, and they didn't panic sell their long-term equity positions because they knew from history that markets recover. The S&P 500 has historically averaged about a 0.9% dip in the first month after a major geopolitical event, and then risen 3.4% in the 6 months that follow. That's according to Carson Group, which analyzed 40 major geopolitical events over the past 85 years, from World War II to today. Person B knows that pattern, so they don't flinch. 5 years from now, person B's defense stocks have compounded. Their gold holding has protected them through at least one more crisis. Their energy exposure has generated strong dividends, and their emergency fund, boring, unexciting, parked in a high-yield account, meant they never had to sell anything at the wrong time. The difference between person A and person B is not income, it's not starting capital, it's not luck, it's financial literacy. It's knowing the 5 moves and knowing them before the next crisis, because there will always be a next crisis. That is, unfortunately, the nature of the world we live in. The Iran war won't be the last geopolitical shock of your lifetime. The question is whether you're building a portfolio that can absorb these shocks or one that's vulnerable to every single one of them. The wealthy don't get rich by being lucky. They stay wealthy by being prepared. And that's the last piece of this. Look, I'm not going to tell you to go out and panic buy defense stocks tomorrow morning. That's not the point of this video. The point is this. The Iran war is a reminder, a very loud, very expensive reminder that the global economy is connected in ways most people never see. That a choke point in the Persian Gulf affects what you pay at the pump. That government contracts for Tomahawk missiles affect equity returns. That a flight to safety in dollars affects your savings account yield. Understanding these connections doesn't make you a speculator, it makes you informed. And the 5 moves we walked through today, gold, the dollar, defense stocks, energy, and cash, aren't emergency reaction plays. They're the building blocks of a portfolio that doesn't fall apart every time the world gets complicated. You get to decide what to do with this information. Maybe it's reviewing your asset allocation this weekend. Maybe it's setting up a high-yield savings account for the first time. Maybe it's just having a conversation with a financial advisor who you've been meaning to call for 6 months. The question isn't whether the world is going to keep throwing curveballs at your finances. It will. The question is, when the next one comes, are you going to be person A or person B? That's entirely up to you.